This is InvestTalk. Independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Wednesday, May 24th, 2023 edition. I'm Justin Klein. I'm here today to help you become a better investor. Simple as that. And I do that by giving you the right data and perspective that I've developed over 20 plus years of investment experience. And of course, I'm going to blend what I want to talk about and my comments about today's market and environment with the questions that you bring, the topics you select. And that's ultimately what this is about. You set the table for today's show. And that's why you're a vital part of every InvestTalk podcast. Now, here in InvestTalk, we do not pre-screen our live calls in order to shape the show. Just a quick background, I have a team behind me, and they take the calls, and then I get an instant message that says, hey, John from Indianapolis wants to talk about this stock or this topic or whatever, and we put them on. And so it's very organic, very straightforward, and I don't even the ones that are recorded, I don't hear those usually until they're just played on air. So I try to make it very organic in that way, and that's why we love your live calls and committed to answering as best as we can with our viewpoints and our experience. So we do this with no hidden agenda. Just unbiased guidance to help you pave that path forward, that path towards successful investing. Now, Steve and I encourage you to do a few things. Ignore emotions, or at least try to quell them as much as you can. It's a natural part of being a human, but it's also the antithesis of good investing. So you have to refrain from chasing headlines and focus on the task at hand. Now, the more you teach yourself to use the best practices, the more you will eliminate your counterproductive habits, the more you will avoid the pitfalls, and the quicker you will achieve financial freedom. So I'm ready to tackle your questions, and if you have any, give us a call. The InvestTalk phone line never closes. It's 888-99-CHART, 24 hours a day, 7 days a week. You can call and leave a message, and we'll answer it on a future show. If you're listening live during our live stream program from 4 to 5 Pacific time, you can call right now and talk to me directly. Now, my focus point today looks in the story behind this question. Could required minimum distributions cause you to overspend? So we're going to look at how that is calculated and how to think about that as maybe a guide to your spending habits in retirement. I also have a few other topics on the docket. Obviously, the debt ceiling, that's top of mind for most people. And I'm going to look at what the Treasury could do if we do hit that debt limit, and then ultimately the economic impact, both near and potentially long term. Also, thousands, tens of thousands, hundreds of thousands potentially of small-time investors, which that's where most of the landlords are. They're small-time investors, and they own individual properties, collecting rents, and many of them are feeling the pinch during this housing, I wouldn't say call it a bust, but certainly pullback. And we're going to look at some data there. And then lastly, the oil markets and the plan for the Biden administration to refill the strategic oil reserve. Will he do it? Won't he do it? How will they do it? We're going to look at that topic because I don't think we've addressed it really in a while. So those are the things that are on the docket for me, but this is about you once again. And we're going to get to your voice bank questions as well as a few of your calls in regards to technical indicators, as well as Kraft, Heinz, and an iTunes review question as well. So I have this all planned for this Wednesday episode of Invest Talk. And of course, we're taking your live calls at 888-99-CHART. Now let's take a look at the market today. And it was a decidedly weak day. You had real estate down the most, down about 2%. Financial services down about 1.3%. Basic materials 1.2%. Energy was the bright spot, up about 0.44% today. And that was a really interesting sell-off later in the day. And this is something that I was expecting a bit, a sell-off into month end as this debt ceiling approaches, and there's a lot of more headlines about what's going to happen next. And that's to be expected, right? Volatility has been low. We've had a little bit of a pullback here, but we remain kind of in a consolidation period, really for about 2.5 months now. A bullish consolidation period, a choppy one, probably a difficult one for most investors, but a bullish one nonetheless. I think after we get through this, which I do think we will, even though we'll broach that topic here later in the show, I do think we have more upside in the market, maybe before real volatility. I don't think this is real volatility quite yet. Now we're going into a quick break. Please remember that you can call anytime and leave your question on the InvestTalk voice bank, or if you're listening via the live stream on 888, you can call right now at 888-99-CHART.
The KPP Premium Newsletter won't guarantee your success, but it can help you become a smarter investor. And here's good news. From now through Memorial Day, each new subscriber to the KPP Premium Newsletter will get a free copy of Steve Peasley's book, Above Average Investing for the Average Investor. That's right. You listen to Steve and Justin on Invest Talk, and now for a limited time, you can receive a free copy of Steve Peasley's book. When you subscribe to the weekly KPP Premium Newsletter, you'll get an up-to-date analysis of current market conditions, 2 stock ideas that Steve and Justin think you might want to watch, and tips on how to properly manage your portfolio assets. Learn more and subscribe now at kppfinancial.com. And please be sure to tell your friends and family members. Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. That means you'll have finance and investment questions. Justin Klein is ready to provide his unbiased answers. So don't forget to call Invest Talk, 888-99-CHART.
Hi, Justin and Steve. This is Steve from Mission Viejo, California. I wanted to get your thoughts on Disney. It's come off quite a bit from its highs. It's been in the news quite a bit, and just wanted to get your thoughts on now being a good time to jump in. Thanks. Appreciate all that you do.
All right. Looking at Disney, I don't think I need to explain what Disney does, but they've certainly reversed pretty much the entire pandemic gain and almost then some, right? During the pandemic, the price of Disney went from about $140 right around the pandemic and hit a low right around in the high 70s. And now we're at 89, even though it hit a high back in, 2021, over $200 per share. So you're talking about down over 50% from its high. But remember, that's never a reason to just simply buy a stock. Just because it's down 50, 60% doesn't mean that that is a great buy. It could have just been drastically overvalued back then. And I think Disney definitely was at 200. Now, earnings this year are supposed to come in at about $4 per share. That's up 12% from last year. But those expectations continue to come down. Analysts' trends there are down. Now, last quarter, revenues are up 13%. Earnings are down 14% year over year. And obviously, that's why they continue to come down. Now, Disney Plus was a big driver of why you had the stock up so much, people overvaluing the potential of that platform. but it's done fairly well. Probably better than most people had expected to a degree, and they've actually recently raised prices, which I think is a smart thing to do, right? They have a very strong IP portfolio. You could argue one of the best in the world, especially in the entertainment business. So it's hard to argue with that. Now, one issue with their business is that they are, ESPN is a big part of their business. They also own Hulu, and with the cord cutting, ESPN is a big driver of the reason why people have cable, and the rights to that continue to kind of go down as there are more and more cord cutters. And I think that's only going to continue, and another reason why you see their business continue to struggle. Now, if you look going forward, earnings of, say, $4 per share, it's still trading at about 22 times forward earnings, which, isn't exactly cheap, okay? Enterprise value to EBITDA right around 16 times. And, that is right about where it was trading pre-pandemic, okay? So I think now Disney is fairly valued. I don't think it's expensive anymore after this decline. But you don't buy. Remember, I say the market's like a pendulum, right? It's going back and forth between people that are overly bullish and overly bearish. And usually it doesn't stop in the middle, right where fair value is on a company. And so that would be my ultimate worry, is that this is going to completely go the other way and become eventually really undervalued. And I don't think it's quite there yet. Now, if it gets to about $61 per share, that's where I start to think, okay, it is sufficiently undervalued. There's the margin of safety for me there to pick it up. But that's my buy point right around low 60s. All right. Thanks for the call. Now let's try to make it 2 in a row from 888.99 chart.
Hey guys, love to get your thoughts on Kraft Heinz, ticker symbol KHC. Looks like it came off its highs and pays pretty good dividend. Just looking for it to hold it for a long term. Thanks.
All right. Now, first off, you should never lead with the reason to own a name is the dividend. Dividend's secondary. Dividend is simply a capital allocation decision by management. Companies that are profitable, they have some sort of income, cash flow, etc. They have to figure out what to do with that money. Some reinvest it in the business. Typically, those are more growth-oriented names. Others buy back stock. Others pay dividends. So it's just simply a capital allocation thing. So it's just more about the strength of the business. Earnings are supposed to be $3 per share next year, trading at $38 per share. It's about 13 times forward-looking earnings, but it's a very slow growth business, right? This isn't an exciting business whatsoever. The technicals, they're pretty neutral, I would call them. And if I'm looking at the valuation, about 14 times, I think it's a little bit overvalued, to be honest with you. I just don't, I'm not in love with the business at these prices, at least not yet. So I would say it's modestly overvalued and the technicals are poor. So I'm going to pass on Kraft Heinz for now. Now we're heading to a break. I welcome your finance and investment questions now at 888-99 chart.
The stock market is constantly changing, and serious investors know that they need to modify their portfolio assets to fit the times. And now, with more than 50 million downloads, Justin Klein and Steve Peasley reaffirm their commitment to providing unbiased finance and investment guidance here on InvestTalk. 888-99-CHART.
Now, my focus point today looks in the story behind this question. Could required minimum distributions cause you to overspend? And this is an interesting topic because the calculations have changed throughout the years. When you take RMDs has changed. It used to be, I believe it was 70, and then it went to 72. Now it's 73. And, these things evolve as well as life expectancy. Okay. Now, what unfortunately happens for retirees is they take money out due to RMDs, required minimum distributions. This is what you're forced to take from 401ks and IRAs that have never been taxed, right? Pre-tax dollars. And you think, well, now I have it. I'm going to go spend it. But that's a lack of really forethought and planning. And then I realized there's a few options that they can take advantage of. Now, what's interesting is beginning last year, RMD tables used a different calculation and revised to incorporate longer life expectancy. And this means that RMDs are now a bit smaller than they were before and actually help with this. It's a little bit more conservative of a withdrawal schedule. Not in a big way, but slightly. Now, there's an interesting way they calculate it. And it has to do with your life expectancy at that particular age. So it's not straight line, meaning if you are 73, if you're 73, they expect a male to, if you're 73, your distribution period is 27 years. If you're 73, it's 27 years. At age 80, you would think that it's 20 years. Well, no, it's actually more than 20 years because at 73, a man is expected to live about 12 years on average, a woman 14 years. At the age of 80, 7 years later, a man is supposed to live 8 more years and a woman 10 more years on average. So, every year that you actually survive, your life expectancy goes up. And that happens no matter what age you are, right? So that's always interesting. So one example of this change is that if you are 75 years old, before you would divide your account balance by 22.9 to come up with your RMD. But now, because of longer life expectancy, you would divide that by 24.6, which means if you had $1 million in your IRA or 401k, before it was a $43,668 RMD. Now it's a $40,650 RMD. So about $3,000 difference. And that's actually a positive. But the question is, what do you do with that money? Well, the first thing you can do is you can reinvest it, right? Put it in a taxable brokerage account, right? And you invest that tax efficiently or in the best way possible based on the market conditions and your goals and your needs. Is this money earmarked for the next of kin? Maybe you want to be more aggressive. If you want to continue to live off that money, live off the income, then you want to be more conservative and maybe buy treasuries, corporate bonds, munis, depending on if you're in a high tax bracket, etc. So something to consider as an option. You don't have to spend it. Now, another option, a lot of people don't know this, if you have a spouse or yourself that has earned income greater or equal to a potential contribution, you can invest the unneeded RMD in a Roth or traditional IRA. Typically, you probably want to do that in a Roth, so you don't have to, you're not on a wheel, right, where you take money out of the IRA and then just put it back in as a contribution. You can actually do that if you have earned income, right? So if you're 75 and maybe your spouse is 64 and your spouse is still working, you can take your RMD and put it as a contribution, a spousal contribution, even if you're not working anymore. So that's a little known wrinkle that you have to consider. But the long and short of it here is that don't use your RMDs as a guidepost for what you should take out. And the reason is because as you get older, the percentage of percentage that you take out goes up. So at age 73, it's about a 3.8% withdrawal rate. At 80, it's a 5. At 85, it's a 6.3. Because that's what's going to happen is because that divisor gets smaller and smaller each year, you're going to have to take more and more as a higher percentage. So as you get older, that percentage becomes quite large. And that could be an issue if you don't reinvest it and you spend too much of it. All right. Now, next Invest Talk, the story behind this question. Why is crypto acting like a risk asset again? Bitcoin and Ether are on pace for the worst month of 2023, down 10% and 6%, respectively. That story tomorrow, but for now, I'm Justin Klein, ready to take your questions live at 888-99-CHART.
Finding great candidates to hire can be like, well, trying to find a needle in a haystack. Sure, you can post your job to some job board, but then all you can do is hope the right person comes along. Which is why you should try ZipRecruiter for free at ZipRecruiter.com/post. ZipRecruiter doesn't depend on candidates finding you. It finds them for you. Its powerful technology identifies people with the right experience and actively invites them to apply to your job. You get qualified candidates fast. So while other companies might deliver a lot of hay, ZipRecruiter finds you what you're looking for. The needle in the haystack.
See why 4 out of 5 employers who post a job on ZipRecruiter get a quality candidate within the first day. ZipRecruiter, the smartest way to hire. And right now, you can try ZipRecruiter for free. That's right, free. At ZipRecruiter.com/post. That's ZipRecruiter.com/post. ZipRecruiter.com/post.
When you download the Kroger app, you have easy access to savings every day. Shop weekly sales and get personalized coupons to get the most value out of every trip, every time, whether you shop in-store or online. Download the Kroger app now to save big. Kroger, fresh for everyone. Must have a digital account to redeem offers. Restrictions may apply. See site for details.
Save big on your favorites with the Buy 5 or More, Save $1 each sale. Simply buy 5 or more participating items and save $1 each with your card. Kroger, fresh for everyone.
Without the ones like you, who work tirelessly to keep things running, everything would suddenly stop. Hospitals, factories, schools, and power plants, they all depend on you. No matter the weather, emergency, or time of day, you're the ones who get it done. At Grainger, we're here for you with professional-grade industrial supplies. Count on real-time product availability and fast delivery. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. So as long as your questions involve the stock market or general investment topics and definitions, we set no limits. You, the caller, get to chart the course for each InvestTalk podcast. Justin and I are ready. Are you? Call with your questions anytime, day or night, 888-99-CHART.
Hello, Steve and Justin. This is Paul from South Carolina. I'm a longtime listener and first-time caller. I want to thank you for all you're doing for us investors and for your show. My question is twofold, and it's about technical indicators, especially the cup and handle pattern and a double top pattern. I was wondering if you could please explain to me the differences between the two and how to tell the two patterns apart, because they seem to have many similarities, but of course very different outcomes, the cup and handle being bullish and double top being bearish indicators. I haven't been able to find any information on the internet on how to differentiate between the two, so I was hopefully to ask you for your expertise. And the second part of this question is about gold, and in particular, the stock NUGT. It's a 2 times directional daily gold miners index. The 1-year chart and the 6-month charts are showing, I think, a cup and handle pattern. And I was thinking about making a trade. I think it's, would this be a good vehicle for a short-term trade? Again, thank you so much for your show, and I'll be listening for your answer on your podcast. Thank you.
All right, well, let's start with the first part, which is the difference between a cup and handle and a double top. And the answer is the difference is one's bullish, like you said, and one's bearish. Now, I'm not a huge like cup and handle type of person. I think that the end of the cup and handle is simply a move higher and a consolidation period. And sometimes that consolidation period is a pullback before that ultimate launch higher. And that's all that is. Just because there was a long period where it was in the doldrums that created this cup doesn't make it, I think, any more or less bullish than a normal move higher and consolidation period. So that's all that is. It's just bullish consolidation. Now, a double top, that can mean a lot of different things, and it could mean just a start of a consolidation period that ultimately breaks out and moves higher. So it's hard for me to explain this all over the air because charting is a visual thing. You have to look at a chart, kind of show you how these things work. So that's my answer on that part. Now, when it comes to NUGT, the first thing you have to do is never look at this chart. Let me repeat that. Never look at this chart. Why? Because this is a derivative. This is a derivative. This is an ETF that derives its price from another security. Right? So this is tracking the gold miners, the GDX, 2 times. So it's going to move based on what GDX does. So the pattern on GDX is actually what you want to be looking at. Not NUGT, because there's a lot of tracking error in these leverage ETFs. You don't want to use these as long-term buy and hold vehicles. Any levered ETF, whether long or short, doesn't matter. Okay. So if you want to go and look at GDX, is it bullish? I would say, yeah, it's having a pullback now, but it still remains in a broader, longer-term uptrend. It's not a powerful one, but it's certainly making a series of higher highs and higher lows, really since the bottom in 2016. So is GDX, bullish? Yeah. Overall, longer term? Yes, it is. But that's, once again, that's a longer term pattern. When you're buying these levered ETF, you want to hold them for a week or 2 weeks, maybe 3 weeks max because of that tracking error. So you're making a play on a short-term move. If you want to own GDX, own gold miners, because longer-term picture is still pretty bullish, then just own GDX. Don't go out and buy NUGT. Okay? Thanks for the call. Now let's talk a bit about the debt ceiling. The debt ceiling is certainly top of mind. It's bringing headlines. It's bringing market volatility. And the question is, what will happen? What are the potential ramifications? Now, if Congress is late to raise the debt ceiling, I think eventually we all know they will. It's just a matter of timing. The federal government could do a few things. It could not pay some of its obligations. And that could be servicing the debt, but it could also mean prioritizing servicing the debt and not paying other priorities. So basically, all the tax revenue that comes in the month of June, it would just go towards paying back interest and principal for our debt. And that would mean that non-interest spending, such as Social Security, Medicare, Medicaid, defense, civil service salaries, they would all need to be cut. Furloughed for a time. And that would need a cut of about 27% of all of that spending. So over a quarter. Now, let's say the Treasury prioritized Social Security because so many people rely on that for just simply living. Well, that would mean all that other spending would need to be cut by 35%, over a third. So federal employees, military personnel, government contractors, they would all see their income drop dramatically and furloughed, which would have a lot of knock-on effects on the economy. Now, corporate tax receipts are going to come in June, so that's going to help maybe stave off major furloughs, major problems for a short period of time. But that's, once again, very temporary. And this would have an impact on the overall economy. Right now, second quarter GDP expectations based on the Federal Reserve's Bank of Atlanta GDP Now forecast is 2.6% this quarter. And if you did have a large cutback in non-interest expenditures, you'd probably see second quarter growth go negative. And probably the third quarter as well. It would almost guarantee we're in some sort of recession by the early third quarter. Now, I think we're going to go into a mild recession late third quarter, early fourth quarter anyway, but this would probably bring it forward a bit. Now, what sectors would be hurt the most? Well, consumer discretionary. Restaurants, tourism. If you're not getting paid, you're probably not going out to eat very much. And this happened in 2011. There was a debt ceiling impasse back then. So this is nothing new, 12 years ago. Consumer sentiment fell, stock market declined a bit, and then ultimately we rebounded in 2012, which, I think that's what you're going to see, a mini version of that, right? You've seen that so far this week. Maybe we get more pullback next week as well. But ultimately, this is a game of political brinksmanship that we've seen many times before. Now, another potential outcome could be Biden instructs the Treasury to ignore the debt limit, invoke the 14th Amendment, and then there's a legal battle that happens. I actually don't rule this out because basically you're forcing the Republicans to sue, basically saying, hey, you should default on the debt. I don't know how politically palatable that could be. And also, the courts would have to accept it. I mean, the courts could actually say, you know what, this isn't something we should be deciding. This is a political issue that you guys need to work out. And obviously, this creates reputational risk and could create major problems for the banking sector, especially because they own a lot of these treasuries. People become more risk adverse. Credit spreads could widen. You've seen that over the past couple of days. And really, that would be that ultimate down the line effect. Borrowing from corporations, being able to service their own debt, that would become more difficult. Now, ultimately, the high cost of a technical default probably means there's a last minute deal. Like there always is. And I still put that much higher than the market is expecting. I think it's now a 30% chance of a default. I think it's less than 5%. But something to watch, and I wanted to get to it because it's important to follow, but don't get too caught up in it. Because this has happened many times before, and everyone has the same reaction. And part of that's good, right? Having that fear of it is what ultimately brings the deal. When people stop being fearful of it completely, that's when I'd probably be a little more worried. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for the courtesy by getting to their questions quickly. Beirut Don says, what about LDOS? Its P is slightly higher now, but is expected to earn $732 next year. Makes it seem like a slight bargain. Do you guys still think this is a good company? And now that it's cheaper buy, I don't personally remember saying this is loving this company. It has pulled back pretty dramatically, 27% down from its 52-week high. Low growth business. Last quarter, revenue growth 6%. A couple quarters before that, 4%, 5%. A couple quarters before that, earnings were down 7%. And what do? They provide scientific technology solutions primarily in the area of national security, health, and engineering. So they sell things like the the wonderful TSA screening scanners that you have to stand on the yellow foots and they scan you. They make those for the Department of Homeland Security and a lot of other things for the government. Obviously, if the government is looking to cut spending, could this be a reason for that? Right? So they service a lot of government spending that's not your traditional entitlements. And I'm actually seeing this. There's actually a signal in the market that if you look at LDOS as well as a Lockheed Martin, right? Go look at I guess it wouldn't be LMT. What's the other major contract? LMT is down pretty decently from 500 to about 440 over the past month or so, as well as some of the other defense contractors. I don't have that off the top of my head, but I definitely have been noticing a trend where they're struggling. And is this a signal of the market saying, hey, our fiscal situation is getting so dire, and our entitlement spending is going up so dramatically that they're going to have to cut defense? Right now, the Republicans don't want to cut any defense. So, does that ultimately mean that they're going to? The market is kind of signaling that. And I don't like that. And expectations for earnings this year and next year continue to decline. I don't like the trends in the charts. I don't like the trends in the business. It's not cheap enough for me to get excited about it. And there's not that clarity on the business for me to jump in. So I'm holding off on LDOS and waiting for a little more clarity on government spending. Now here's a reminder. Now is an especially good time to subscribe to the KPP Premium Newsletter. From now through Memorial Day, each new subscriber will get a free copy of Steve Peasley's book, The Above Average Investing for the Average Investor. We'll send you an email directly, get your address, and ship you out a copy. And when you subscribe to the newsletter, you will get an up-to-date analysis of current market conditions, 2 stock ideas that Steve and I think you might want to watch, and tips on how to properly manage your portfolio. You can learn more and subscribe now at kppfinancial.com. Now we're going to head over. Are we doing a break or are we going to head to Sid? All right, we're going to go to Sid in North Carolina looking at EBS.
Hi, Justin. Thank you for taking my call. Good evening. Yes, I'm looking for EBS. I have a very small position in my portfolio, and I think I have picked up at the wrong time when I was learning all these things in the beginning. So it was a buying price of 64, and right now it's in single digit. Do you think this is a good price to add something for the dollar cost point of view, or I should forget it? I have a less than 0.1% of my portfolio. Thank you.
All right, this is Emergent Biosolutions. They offer public health products, the government and healthcare providers. What's interesting about this name is that they were earning nice profits, kind of up until the pandemic. Their cash from operations now is negative $180 million. Pre-pandemic, let's take a look back here. Let's go to 10-year chart. Oh, that's interesting. Yeah, so pre-pandemic, their business was kind of already rolling over. And then the pandemic kind of saved them, right? If you look at September of 2019, so the third quarter of 2019, they dipped into negative about $100 million in operating cash flow after many years of kind of vacillating between 100 and 150 million in operating cash flow. And then their business surged to positive 500 million in the fourth quarter of 2020. But now it's back to negative 180 million. And earnings this year is supposed to be negative $1.51. The technicals look terrible, trading at $8 per share. I see no reason to own this name. Technicals are poor, the fundamentals are poor. Yeah, I would actually sell it and move on. Now we're heading into our final break. So if you want to give us a call now, you can do that at 888-99-CHART.
From now through Memorial Day, each new subscriber to the KPP Premium Newsletter will get a free copy of Steve Peasley's book, Above Average Investing for the Average Investor. Learn more and subscribe now at kppfinancial.com.
Hey,
Steve and Justin. Quick question for you. CF Industries, ticker symbol CF, got it at about 1% of my portfolio right now. Been headed down for the last 6 months. I'm probably down 36% on it at the moment. Is this still something that you guys foresee has a positive future? If so, would this be a good time to maybe double down or buy some additional shares? Thanks. Bye.
All right, this is CF Industries, and they are a manufacturer of nitrogen fertilizers. And this is really a play on natural gas arbitrage. That's really what it is. Because the way you make these synthetic fertilizers, about half of fertilizers in the world are synthetic, meaning they use some sort of, use usually natural gas that they inject into the fertilizer or to create the fertilizer. They make it cheaply here in the U.S. because our natural gas is very cheap, and they export around the world. And their business boomed during the war last year because natural gas prices in Europe were multiple times what it was here in the U.S. And so they were making a ton of money on the arbitrage. They earned $18.88 last year versus $6.56 the year before. And they're supposed to make $8.81 this year because that arbitrage has shrunk. I do think that longer term, it's going to continue to be very robust, and they're going to earn strong returns. However, that arbitrage, once again, continues to kind of shrink a bit. So I think long term, the geopolitical problems in Europe aren't going to change. The lack of energy coming out of Russia to Europe is not going to change, right? They're basically no longer going to be getting cheap natural gas from Russia. So they're going to have to find it other places, and it's going to be a lot more expensive. And therefore, the ability to make nitrogen fertilizers in Europe is really not going to be very economical. So they're going to have to turn to companies like CF Industries, who can basically arbitrage the difference. And I think long term, they will do well, even though that arbitrage is shrinking today, and that's going to always ebb and flow. But I think generally it's going to stay elevated, and they'll earn good money. All right. Thanks for the call. Let's talk a bit about syndicated real estate investments. And you're starting to see some of them go under. And one of the biggest ones is called Apple's Way Investment Group. And they, at one point, were one of Houston's biggest landlords. And they got dozens of small investors to pony up thousands and tens of thousands, sometimes hundreds of thousands of dollars. And they pitched them, doubling their money, right? It's kind of one of those too good to be true type of pitches. And a lot of people fell for it, right? YouTube videos, investor conferences, that's how they got their investors. And they describe buying up older apartment buildings, cleaning them up and raising rents and selling for a profit. And they basically they acted like it was low risk or no risk. However, they were not very smart, and they were borrowing money on floating rate loans. And now Apple's Way Investment Group is bankrupt because of it. They didn't lock in the low 3.5% rate that they could have back in 2021. Inflation increased, so it's more expensive to shine up these properties, and bills went unpaid, and companies' properties went into foreclosure. And this is just one of thousands of real estate syndicators that are out there. From 2020 to 2022, real estate syndicators reported raising $115 billion from investors. This is according to the SEC filings. Now, Congress back in 2012 opened the door to syndicators with a law that made it easier to market real estate investments online. And that's why a lot of people are putting money into these online REITs, syndications, etc. Most people don't know exactly what they are, but the history of these things just really aren't that great. Just because they used to be pitched in rooms at hotels, right, conference rooms, but now they're pitched online. And the problem with a lot of these syndicators is there's a lot of conflict of interest. They earn about 2 to 5% of the purchase price of the apartment building, and they earn a management fee of 2 to 3% of gross income. So they often make money even if the investment fails. And there's big followers. Grant Cardone was the founder of this fund. Grant Cardone was his mentor, right? And Grant Cardone has 4.3 million followers. Not to say that Grant Cardone doesn't have positive things to say, but the main takeaway here is don't buy into that just because you see it online. Understand the risk that you're taking. Understand what could go wrong. And if it sounds too good to be true, it probably is. And for a lot of these real estate syndications, it's going to end up badly. I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial.